Hey everyone, welcome back to Corporate Decoder, the place where we unravel the sometimes confusing world of corporate filings. Today we're diving into the Hamilton Lane Private Assets Fund's latest prospectus, a document that promises insight into the fund's strategy. Are we going to uncover hidden gems or just a lot of fine print? Well, let's just say the risks section alone could keep you up at night. This prospectus is like the instruction manual for the Hamilton Lane Private Assets Fund. It's basically laying out how they plan to make money by investing in private assets all over the world. The Hamilton Lane Private Assets Fund wants to generate capital appreciation, which is a fancy way of saying they want their investments to increase in value. They plan to invest in private assets, which are things like direct investments in companies, subscriptions to private funds, and even buying existing investments from other funds. They are hunting for profits in the less traveled corners of the investment world. Now, before you get too excited, the prospectus has a lot of warnings. They really want you to understand that investing in this fund comes with a high degree of risk. They want you to read the sections titled General Reichs, Investment Choice, and Answers of Reichs Disclosure. It's like they're saying enter at your own peril in corporate language. The fund is offering different classes of shares, Class R, Class I, and Class D. The price and fees vary between these share classes. For Class R shares, there is a sales charge of up to 350% of the investment. Meanwhile, Class I and Class D shares do not have a sales charge. They're hoping to raise up to $4,000, that's a whole lot of zeros. This is a continuous offering, meaning they're constantly selling shares. Again, there are big disclaimers all over this document. Shares are speculative, they could lose value, and you shouldn't expect to be able to sell them whenever you want. The fund doesn't have a long track record, so there's not a lot of past performance to rely on. It's like betting on a rookie player. Okay, let's talk about where your money goes. This section breaks down all the fees you'll be paying directly or indirectly. If you buy Class R shares, be ready to pay a sales load. Think of it as a commission of up to 350%. Class I and Class D shares don't have this sales load. If you try to sell your shares within a year, you'll get hit with a 20% early repurchase fee, unless the board decides to waive it. The fund pays Hamilton Lane, the investment advisor, an annual management fee of 140% of the fund's managed assets. This is a recurring fee, so it adds up over time. The investment management fee is calculated monthly. Then there's the incentive fee, which is where things get interesting. The advisor gets 10% of the fund's net profits above a certain threshold. This can really add up if the fund performs well, but it also creates an incentive for the advisor to take bigger risks. There are also distribution and servicing fees, which are used to compensate financial intermediaries. Class R shares get charged up to 0.70%, and Class D shares get charged up to 0.25%. The fund has estimated interest payments on borrowed funds as 0.05%. Shareholders also indirectly bear a portion of the assets fees, performance or incentive fees or allocations, and other expenses incurred by the fund as an investor in the portfolio funds. The total annual expenses come out to 3.99% for Class R shares, 3.29% for Class I shares, and 3.54% for Class D shares. They're trying to illustrate that investors are going to bear a lot of fees, and the table is provided to assist in understanding of how shareholders will bear directly or indirectly. The example of fund expenses shows that if someone invests $1,000 in Class R shares in the fund, they would pay $74 after the first year, assuming a 5% annual return. After 10 years, the total cost will be $449 respectively, assuming a 5% annual return. Now, let's see how the fund has actually performed. This section gives us some historical financial information. Looking at the Class I shares, the fund had a net investment loss per share of $0.214. In the year ended March 31, 24, the fund had a net investment loss per share of $1.25. The fund had a net investment loss per share of €25. However, the net realized and unrealized gain on investments was 1 per share for the 6 months ended September 30, 2024, and 2004 for the year ended March 31, 2024. The net asset value per share at the end of the most recent period was 16.76 Gross expenses were 3.51% for the 6 months ended September 30, 24, and 4.26% for the year ended March 31, 2024. The money they get from selling shares will be used to make investments, and they may hold some of it in short-term investments until they can find suitable opportunities. The fund wants to generate capital appreciation or growth over the medium and long term. They might borrow money to try to boost returns, which is a risky move. Under normal circumstances, the fund intends to invest at least 80% of its net assets in private assets. The fund is relatively new, so there's not much of a track record. This isn't a savings account. You can't just take your money out whenever you want. The fund might offer to buy back shares from time to time, but they're not obligated to. If the fund does buy back your shares, they might not pay you in cash. They could give you securities, which might be hard to sell. The fund isn't diversified, meaning it could put a lot of its eggs in a few baskets. Changes in laws and regulations could hurt the fund. If too many people want to sell their shares, the fund might have to sell its investments quickly, which could lead to losses. If the fund can't find good investments, it might hold a lot of cash, which won't generate much of a return. Now we talk about risks connected to how the fund is run. The way the managers get paid could encourage them to take on too much risk. These are connected with the organizational structure and how things work. You're trusting the advisor to make all the right calls. The fund has to compete with other investors for deals. Now we talk about risks related to the kinds of assets the fund invests in. Investing in troubled companies is risky business. Changes in interest rates could hurt the fund's investments. This is just a summary of the risks. There could be other risks that they haven't even thought of yet. The fund has a board of trustees who are responsible for overseeing everything, and they've hired Hamilton Lane advisors to actually manage the investments. Let's see who these people are. The board includes Andrew Shart and Brian Charles Gildeer, among others. In consideration of the services rendered by the independent trustees, the fund pays each independent trustee a retainer of $35,000 per year and an additional $5,000 per year for the board chairman. They use ISS Proxy Exchange to help them decide how to vote on company matters. And all in all, Hamilton Lane Private Assets Fund presents itself as a unique vehicle for gaining exposure to private asset markets. It offers access to deals and strategies that are normally out of reach for individual investors. However, this access comes at a cost. The complex fee structure, the inherent illiquidity, and the reliance on the advisor create a risk profile that isn't suitable for every investor. The heavy warnings about the risks throughout the report are really notable. They really don't want you to blame them if you lose money. From a financial health perspective, it is hard to tell because it is forward-looking. The management fees could easily outweigh any profits. It also will perform very closely to the stock market in general due to their strategies. In conclusion, the Hamilton Lane Private Assets Fund might be something you should look into if you have a very specific risk profile, but otherwise is something to treat with caution. Thanks for watching, and be sure to like, comment and subscribe to Corporate Decoder for more simplified views of complex corporate filings.